International Consolidated Airlines Group, or IAG, is the parent company of airline carriers such as British Airways, Iberia and Aer Lingus, to name a few. IAG has been one of the worst affected airline stocks, with its share price having dropped by over 50% since the beginning of 2020. This drop, amongst other recent events concerning the company, has grabbed our attention at the investment store, as it looks as though it's currently in bargain territory. Is this boxing clever, or penny wise pound foolish? Well, let's analyse IAG and take a deeper look at the company on today's investment store. Welcome to the Investment Store, the personal finance channel that reviews a diverse range of investment asset classes, from stocks and ETFs through to real estate and cryptocurrencies. If you enjoy this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. With that said, let's commence with today's video. At the Investment Store, we take a four-step approach to analysing stocks. We first analyse whether a company has any form of economic moat that gives it a competitive advantage. Next, we assess the organisation's financials by taking a look at their financial statements and key investment ratios. We then compare the stock with other companies and investment funds in the same sector to assess how they're performing within their market. And finally, we calculate the intrinsic value of the stock to see whether it's trading below its fair value. Once we've completed our 4 steps, we will aggregate the scores to generate the investment store score, or ISS, for the stock. Now, with that said, let's start with the analysis. We recently did a video on Southwest Airlines where we talked about the fact that the airline industry is generally considered as a no-moat industry due to its competitive landscape. Taking this into consideration, the scores that we have recorded here will be predicated on how well IAG fares against its competitors, rather than in a broader context. So looking first at the intangible aspect, IAG was formed in 2011 after a merger between British Airways and Iberia, the national carriers of the UK and Spain respectively. Since its creation, it has acquired other airline carriers such as British Midland, Aer Lingus and Air Europa. The group also owns the budget airline Fly Level and the Avios reward program. These are all relatively strong brands, so we score IAG a 7 out of 10 in this area. Moving on to switching costs, IAG's business model combines long and short haul operations. British Airways and Iberia account for approximately 55% and 22% of the business's revenue respectively. This highlights that the company mainly relies on long-haul flights, which has been heavily impacted by the global epidemic. It's uncertain how long it will take this sector to recover to pre-2020 levels, and when we consider the competitive nature of this sector, it could take a while before we get an appreciation on our investment. And so for this reason, we give IAG a score of 4 out of 10 for switching costs. Moving on to cost leader, IAG has been trying to cut their operational expenses by reducing staff headcount and imposing salary cuts across all levels of the organisation. They have also reduced capital spending by 1.5 billion euros so far this year. Despite this, the business still recorded an increase in operating expenses during the year. And earlier this week, Alex Cruz, the CEO of British Airways, told MPs at a parliamentary select committee that he believed BA is fighting for its survival and requires financial support. This is clearly a concern, so we have given IAG a score of 3 out of 10 for cost leader. Moving on to network effect, IAG covers 780 flight routes across the globe. They are also aiming to develop a common integrated technology platform that will connect their entire ecosystem and give a better passenger experience. IAG has a strong ecosystem of services across its business which can capitalize on the market once we go into a recovery period. So for this reason, we've scored them a 7 out of 10 for network effect. And finally, when we consider scalability, IAG have acquired several businesses over the past 10 years. It also has the financial and political presence to continue expanding its operations globally, so it has some level of competitive advantage over other national airline carriers. Therefore, we score IAG a 6 out of 10 for scalability. This gives IAG an overall Moat score of 6 out of 10. Let's now look at IAG's fundamentals by reviewing the company's financial data. IAG's operating and net margins have been fairly strong over the past 5 years. As we can expect, 2020 margins will be in the negative territory for IAG as they've made a £300 million loss so far this year. So we've scored IAG an 8 out of 10 for operating margin and net margin, as their record prior to 2020 was good. For return on asset and return on capital employed, IAG achieved an ROA and ROCE above 10% and 15% respectively in 2018. Again, as income will be negative this year, these numbers will be in the negative territory. What's interesting here is that if travel behaviours resume to pre-2020 levels, IAG could experience tremendous upside in its revenues and share price. Having said that, we don't know whether this will actually occur, so we've scored IAG a 6 out of 10 for both ROA and ROCE. For debt to equity, IAG's DE ratio is above 1, and our general threshold is to be below 1. What's concerning here is that the Q2 DE ratio has risen to almost 40. This is a bad sign which indicates that the company could have liquidity issues in the short term, and for this reason we scored them a 3 out of 10. IAG's price to book ratio has been reasonably high over the past 5 years, but this has been dropping, which is encouraging. Again, an interesting observation here is that IAG's price to book ratio has gone negative in Q2, meaning that their total liabilities and intangible assets outweighs their hard assets. This is never a good sign, so we score this a 3 out of 10. IAG's free cash flow yield was in double figures for at least once over the past 5 years, which is good for an airline company as they typically have poor cash flows. We have scored this a 7 out of 10. IAG's cash ratio has remained above our threshold of 0.5 for every year over the past 5 years. This is very positive, so we score this a 6 out of 10. And finally, one of the most important ratios to assess airline stocks, or indeed any other company that's vulnerable to financial distress, is the interest cover ratio. This calculation measures how many times a company can cover its interest commitments to debtors with its income before taxes. IAG has a reasonable interest cover of 8.5. Now, although this value would usually be sufficient for a business, IAG are heading into unknown territory over the short term with no clear timescale of when they'll regain profitability, and we could see this interest cover drop considerably in Q3, so we score this a 6 out of 10. This gives IAG an overall fundamental analysis score of 5 out of 10. Next, we'll compare IAG against some of the most famous airlines in the sector, and we'll also compare them against the Jets Airline ETF, which is one of the leading ETFs in the airline sector. To normalise this analysis, we have based most of the comparative numbers on 2019 figures, as we believe using the 2020 results may skew our analysis. Looking first at the net margin, IAG have a reasonable profit margin when compared to other airlines, so we scored this a 6 out of 10. IAG currently have a price to earnings ratio of 1.3, which is very low. And when a company is in this territory, it's either a bargain or susceptible to bankruptcy. Now, we personally do not believe that the UK government will allow its national carrier to go bust, and we think the same applies to the Spanish government. So for this reason, we score IAG a somewhat controversial 10 out of 10. Moving on to interest cover. IAG has a reasonable interest cover when compared to its peers, so we retain the 6 out of 10 score that we gave it during the fundamental analysis. In terms of dividend yield, IAG pays a dividend biannually and have suspended their second dividend for the year due to financial conditions. Despite this, their dividend still ranks amongst the highest in the sector, so we score them an 8 out of 10 for dividend yield. IAG's current ratio is at the higher end of the industry average, being the second highest after Dart Group, the owners of Jet2 Airlines. This is still a low value, as we like a company to have a current ratio above 1, so for this reason IAG scores a 6 out of 10. As expected, the companies with a strong current ratio will also tend to have decent cash ratios, as they generally have sufficient cash and cash equivalents. So once again, we score IAG a 6 out of 10 for cash ratio. For return on capital employed, IAG have the lowest ROCE in the sector, 7.48%, which isn't terrible, but still lower than their peers, so we've scored them a 3 out of 10 here. And next, when we look at the price to book ratio, IAG's price to book is amongst the lowest in the sector. We score IAG a 5 out of 10 here, as although this is at the lower end, their Q2 price to book has fallen into the negative territory. This indicates to us that their share price could fall lower in the short term as a result. The negative price to book is also an indication of high debt levels, and this is reflected in their debt to equity ratio, which is the second highest in the sector. Finally, IAG share price has dropped by over 79% over the past 12 months, which is the biggest drop in the sector. We believe that there is significant upside here, so we score IAG a 10 out of 10 for the 12-month price difference. This gives IAG a comparison score of 7 out of 10. Now, before we move on, we were quite surprised by how strongly Lufthansa and Jet2 performed in this comparison analysis. So we'll be doing some further research on these companies over the next few weeks. The final step in our analysis is to determine the intrinsic value of the stock. At the investment store, we use a discounted cash flow method and Gordon growth model to estimate the value of an investment based on a company's future cash flows. IAG recently completed a €2.74 billion rights issue to raise capital and strengthen its balance sheet. This involved offering 3 shares for every 2 shares owned by existing shareholders. And this has effectively reduced the value of each share, as we will see from the following calculation. Using an annual growth rate of 10%, we calculate an intrinsic share price value for IAG of 214 pence per share. Now, at the time of recording this video, IAG's share price is 110 pence per share. For this price to be justified, IAG would have a growth rate below 2%. Finally, if we were to use IAG's average net income growth rate prior to 2020, which was 15%, we calculate an intrinsic value of 320 pence per share. These numbers suggest that there is some margin of safety in IAG's share price, though in the short term, we estimate that the share price could go slightly lower, particularly when the Q3 results are announced in October. Now, we believe that this potentially could be a good time to assess and possibly purchase some shares in preparation for a rebound in performance. So taking all of this into consideration, we give IAG an intrinsic value score of 7 out of 10. In summary, we have recorded the following scores for IAG, giving them an ISS of 6 out of 10. It's clear that IAG will be facing some difficult short-term challenges within their business, and that its future may rely on external stimulus if global restrictions on travel are extended. Having said that, we are fairly confident that the British and Spanish governments will not want to see their national carrier go bankrupt, so will intervene if necessary. With this in mind, we believe that IAG could offer a great opportunity for investors to make significant returns over the long term. What we also find attractive is the fact that IAG is a reliable dividend payer. So even if recovery in the airline sector takes a few years, we can still benefit from inflation-beating dividend returns. If we were to invest in this stock, we would apply a 10% margin of safety to the current share price, which would take our buy value to 99 pence per share. We will be watching the Q3 results very closely. Of course, this is all conjecture, and if you believe that IAG will not be given financial stimulus and could possibly go bankrupt, then it will be better to look elsewhere and at other companies. Let us know what you think in the comments. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think of our findings. If you'd like to learn more about how we analyse assets, then please subscribe to the channel. We look forward to seeing you on the next video.